Physical Gold Fund presents Global Perspectives with Alex Stanczyk and invited guests. We'll be exploring international markets and the complex forces that drive them, including geopolitics, economics, and the global monetary system. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to the latest podcast with Alex Stanczyk in the series we're calling Global Perspectives. Alex Stanczyk is the Managing Director of Physical Gold Fund. Alex is an expert in the physical gold industry, dealing with the logistics chain from refinery to secure transport and vaulting. And he's lectured globally to investor, institutional and government audiences on the role of gold both in the international monetary system and in investment portfolios. Our guest today is Ronald Peter Stoeferle. Ronald is Managing Partner and Fund Manager at Incrementum AG. His company focuses on asset management and wealth management and is based in the Principality of Liechtenstein. Before becoming a partner at Incrementum, Ronald Peter Stoeferle worked in the research department of Vienna-based Erste Group, where he started writing about gold in 2006. In 2015, he published his first book, Austrian School for Investors: Investing Between Inflation and Deflation. Ronald is the author of the annual report, In Gold We Trust, which was named as the gold standard of gold research by the Wall Street Journal. The 10th edition of In Gold We Trust was released in 2016 and gained immediate worldwide recognition, with newspaper coverage in more than 60 countries. Jim Rickards has described In Gold We Trust as the most eagerly awaited and closely read report in the gold community. So, of course, we're especially excited to be talking with Ronald Peter Stoeferle today. Now, Alex, over to you.
Ronnie Stoeferle, welcome to the call. I'm very excited to have you on. I really appreciate you coming on and spending some time with us. I've been looking forward to having you in a conversation like this for some time now. We first met about 6 years ago at a gold conference in London. Since then, your report, the In Gold We Trust report, has become commonly known as perhaps the most closely read annual report in our entire industry. So congratulations on that great success, Ronnie. I'm a big fan.
Thank you very much, Alex. Thanks for having me. It's true, we know each other for ages, it seems, but I think we met the first time personally at the conference in London when gold was really close to its all-time high at 1900. It was back in the good old days.
The good old days, yep.
We'll get back to that.
I'm sure we will. It's interesting. At the top, everybody's always quite happy, right? And that should have been a good indication. But who knew?
Yeah.
Who knew? Okay, so why don't I'd like to start out with a quote. And this quote comes from your In Gold We Trust report, and it's from Russell Napier. And the quote is, "The time is coming when global financial markets stop focusing on how much more medicine they will get and instead start focusing on the fact that it doesn't work." So, generating growth and inflation has sort of been the central banker's goal worldwide for some time now. And, in light of the observation that this does not seem to be working too well, talk to me about your thoughts on this.
In Japan, we're already having the 12th round of quantitative easing. They call it QQE, so quantitative and qualitative easing. So they're also buying stocks, ETFs, and REITs now. But for some reason, people are not really questioning if it actually makes sense, because if it would work, then why do you need 12 rounds of it? So I think we're in some sort of an end game where the central bankers are basically the only ones who try to hold everything together, but we all know that at the end they're gonna make it worse, because I think you're also a keen reader of history, of monetary history, Austrian School of Economics, and we all all know that we're in a big spiral of interventionism. And, just the fact that the markets these days are only discussing what will Janet Yellen say next, what will this regional Fed director say next, how do we value this piece of information. It's crazy. The market only cares about central banks anymore, and this clearly shows you that this is not a healthy market anymore.
Sure. That makes a great deal of sense. What it reminds me of is the South Seas bubble. I know you read history, as you know I do, and if you read sort of the commentary and the thoughts and the processes of what was going on at the time, it's so similar to these types of really kind of crazy bubbles that we've seen in history, like the tulip madness bubble in the South Seas, etc. It's almost like people have become, completely disconnected from reality and so engaged in this process. Where do you think that ends, or how do you think that ends up?
Well, we should not forget that during history we found out, or we should have found out and remembered, that central economic planning just doesn't work. So why should central planning of monetary policy be any different? Karl Bass said, if command economies worked, we would all be speaking Russian. And so for some reason, people still trust central bankers because they are impressed by their CVs and their PhDs and their academic work that nobody really understands. But I think the manipulation of the most important price in the economy, the interest rate, is really the root cause for all the problems that we're having, not only in the economy and in finance, but also in our society.
Yes, I agree with that wholeheartedly. I think that's right on. Okay, so let's turn our attention for a minute to these interest rates. Let's talk a little bit about that. I'm going to go with another quote here. This one is coming again from your report. It's from Vitas Vasiliasoukas. He's a member, it's hard to say, Vasiliasoukas. He's a member of the ECB's governing council. And when I read this quote, it kind of floored me because of the hubris is just amazing here. He said, markets say the ECB is done. Their box is empty, but we're magic people. Each time we take something and give it to the markets, like a rabbit out of the hat. So this was really amazing to me when I read it. I almost couldn't believe it. Central banks have gone from low interest rate policy to zero interest rate policy, and in some cases, negative interest rate policy in some countries. So what are your thoughts on this? How does this impact the markets? How does it impact society? And how does it impact things like gold?
Well, first of all, for gold, of course, it's a positive environment. The longer we stay that low, the more fragile the whole market will continue to become. We're writing a book. It's called the Nullzinsfalle in German, which is basically the zero interest rate trap, and it means the longer we stay in this crazy interest rate environment, the worse it will get, because then you're so much more sensitive on even a tiny increase in rates that basically there's no way out. And so the moment, what did they say last year? They said there's going to be 4 rate hikes in 2016. How many did we see? Just 1. But everybody was talking about all the time. Now, this year again, they pretend that there will be 4 rate hikes. I actually don't think there's going to be 4 rate hikes. There will probably be one, but sooner or later we all know that an environment of rising inflation, rising rates, and very high valuations, not only on stock markets but also on bond markets, this is always the perfect recipe for a major correction or a crash in markets. So of course for gold that's a positive environment, because negative interest rates they reduce the opportunity cost of holding gold. It's a great environment. We should not forget that rates were rising, but actually inflation was rising much faster, so real rates became more negative, and this is also the reason why gold is doing pretty well at the moment. So I think coming back to this whole interventionism in rates markets, there's quite a lot of fatal long-term consequences of this zero or negative interest rate policy. You know, there's for securities, for example, this poses major problems for all institutional players, for retired people, of course. We all know that. Consequences for debtors, of course. Standard & Poor's has calculated that budget deficits in the euro area would on average be 1 or 2% of GDP higher if the average level of interest rates prevailing back in the days would be applicable today. So nobody could afford higher interest rates anymore. There's consequences for retirement insurance plans. There's consequences for society itself. You're probably familiar with the so-called Cantillon effect. And in our letter to investors, we wrote that the monetary inflation that we're seeing is working like basically a tax. There's people profiting from monetary inflation, and there's people suffering from from monetary inflation. Because based on the Austrian school, there's first is monetary inflation, then there's asset price inflation, stock markets, art, real estate especially, and then there's actually price inflation. This is what central bankers want to see. And there's a huge distribution going on, and I think it's no coincidence that there's such a huge gap when it comes to elections between the rural population and people in urban areas. It's the same in the UK, but also in the US. In urban areas, people tend to vote for the status quo, which would have meant Hillary Clinton, or in the UK against the Brexit, while people on the countryside who are actually suffering, who do not profit from this monetary inflation enough, they are voting against the status quo, so for Donald Trump and for the Brexit. And this is something that we're seeing all over the world. We're writing about many different other aspects and collateral damages of zero and low interest rate policies. We're focusing way too much on short-term profits. We're focusing way too much on consumption. There's some sort of a consumption burnout. We are creating zombie banks. The independence and fragility of financial markets is increasing. It has consequences for entrepreneurs, because everybody is misled by the falsified interest rate signals. So this is really something that is very important for us, and this is why we're dedicating so much thought and work on this topic.
It's really quite dangerous. So, for example, this podcast, we have listeners from all around the world. We have, our audience is about half US and then half many other countries. And these things obviously are global in effect. And what you mentioned about it makes the markets more fragile is a really interesting comment, because you know Jim Rickers. He's a colleague of ours, and he's also a colleague of yours, and he talks a great deal about complex systems and the idea that the whole sort of financial system is a complex system, that it's in a high energy state right now, that could see some sort of a phase transition into emerging properties or adaptive properties, right? We're in a situation right now where central banks are still doing these sort of extraordinary things, and are a long way from normalization. And because of that, it makes one wonder, how long can this go on with the central banks? And, obviously, as you've pointed out, if they keep doing it, what is the effect on the fragility of the market?
Well, yeah. I don't know where to start. I mean, Jim Rickards is bringing up so many great pictures and analogies, and we all know this snowflake analogy. We don't know actually which snowflake is gonna start the avalanche, which one will cause the avalanche to come down. But sooner or later it will happen, and I think one of our calls at the moment is, and this is a highly contrarian call. We think that that a recession actually is pretty much around the corner. When I was in the US a couple of months ago, I said I'm 100% sure that Donald Trump will win the elections, because it doesn't feel like in a recession in the US. It rather feels like in a depression. And I think the both of us were pretty critical when it comes to lots of statistics, especially employment numbers, and also GDP, which is, from my point of view, it's pretty much a useless number, because it doesn't say anything about the quality of an economy. If I crash my car 5 times a week, it actually increases GDP, but do we create any prosperity, any wealth? Does our economy get better by that? I don't think so. So from my point of view, I think that the US will enter a recession sooner or later, probably in 2017 already. We've got quite a lot of indicators suggesting that. Of course, that's a contrarian call, because everybody is so upbeat now with stocks trading at new all-time highs and Donald Trump coming in. But I think that we have, before every recession, we basically saw rising inflation rates, we saw rising interest rates, we saw extremely high optimism. Everything was priced to perfection. So I think where there will be some disappointments coming in, and of course the strength in the dollar might cause a recession, because that's what we call the core periphery disease. The Fed policy affects especially emerging markets, and therefore the strength in the dollar will come back as a boomerang. And probably the weakest link, like always, are emerging markets, like Brazil, like Turkey, which is a big mess at the moment. The whole euro crisis is coming up again. Just follow the developments in Greece at the moment. So I think that a recession might be in the cards. And don't get me wrong, a recession is something totally normal, something really positive and healthy for our long-term prosperity. It's like having a hangover after drinking too much. It's just something normal, something that you have to live with. But if you start drinking beer again as soon as you're waking up with a hangover, I think you don't solve any problems. You're just kicking the can further down the road, the beer can. So from my point of view, really trying to avoid the recession that will come anyways with cheap money and fiscal stimulus. This will make the next recession even worse. And I think when it comes to inflation, I think this is really going to be a big topic going forward, and I'm sure we're going to discuss it within this interview.
You mentioned that the idea of sort of trying to treat the symptoms of the situation will only make it worse going forward. You know what this reminds me of is that typically government solutions, central bank solutions to these kinds of things, I totally agree, just tend to make things worse. In the United States, for a long time, just as an example, there was a policy amongst the government agency that managed the U.S. forests, and the policy was they wanted no forest fires. They wanted to prevent forest fires from happening at all, and they did this for a very long time. And the result of it is that this huge amount of unburnt underbrush kept building up in these forests, and when they finally did catch fire, the forest fires were absolutely horrible, and they were incredible in their ferocity. And it just goes to show you that the natural cycle, just like you said, if there's a recession every 8 or so years, many people know this is the business cycle. That's completely normal, and it's a natural effect, because if that underbrush got burnt off as a natural effect instead of having people trying to control it, then the amount of brush that built up would be nowhere near as much, and the fires would be nowhere near as big. And it's pretty much exactly the same thing. You see sort of natural systems in place, and this idea of, again, the command management of the economy, it just doesn't work. You've mentioned a couple of times now the Austrian School of Economics. Now, people who follow the concepts of honest money, sooner or later, they run across this school of economic thought. We could probably spend hours and hours talking about this, but sort of in a summary, could you explain for those of our listeners who are not familiar with it, what are the basic principles we're talking about here?
In 2 words, common sense. I think the Austrian School of Economics is the common sense school of economics. We could also call it the no free lunch school of economics.
I like that one, yeah.
And Alex, I'm not only from Austria, where actually the Austrian School of Economics is not taught at all on universities or in schools, unfortunately, and this is why we're trying to educate people about our history and our great economists like Menger, like Hayek, like Ludwig von Mises, and so on. And we should actually be really proud on those economists, because first of all, if you really want to learn more about the Austrian school, there's so much material nowadays on the internet. It's just great. We wrote a book. It's called Austrian School for Investors. Austrian investing between inflation and deflation, where we basically focus on the consequences and the advantages of knowing more about the Austrian school for investors. So we're explaining this illusion of prosperity, this illusion of paper prosperity that we're having. We're explaining why the Austrian school is very, very critical when it comes to forecasting and prophecies. Basically says that it's impossible to forecast the future because our economy is so complex. And one big differentiation that one can make is I would say that Keynesians and monetarists, they're working top down. So for them, they try to calculate big aggregates like GDP and so on. While the Austrian school starts at the individual and wants to understand the actions, the human action, like Mises said, because we're not always acting very rational, and understanding that is really important. Then of course there's subjectivism, there's marginalism, individualism, realism. For the Austrian school, for example, there's no objective value, because what's a glass of water worth? It depends. I mean, for me, it's now probably a few cents. But if I'm walking through the desert for 3 days, I'm gonna give everything for a glass of water. But we're seeing decreasing marginal utility of water, for example. So the second glass of water will be worth less, and the 10th glass of water will be worth much less. So we're having those effects basically everywhere. Also when it comes to debt, debt injections made sense under Ronald Reagan when our total debt level was much lower. But nowadays, with 20 trillion of debt in the US, 1 trillion of new debt doesn't really change a lot. So this marginal utility is really important. And when it comes to the big picture, I would say that the understanding of inflation is really crucial, because the Austrian school says money basically isn't much more than a medium of exchange, and if you increase the number of that, it's pretty obvious that the purchasing power will fall. So from the Austrian School of Economics, there's monetary inflation, asset price inflation, and then there's price inflation, as we said before. And this is crucial to understand. If people say there's no inflation, I say that's nonsense. There's massive asset price inflation. There's massive monetary inflation. And sooner or later, velocity or the demand to hold money will pick up significantly, and of course we will see very high inflation, and I cannot rule out that we're gonna see hyperinflation.
Right. So if I'm hearing you correctly, what you're saying is basically 3 phases of how the inflation works. You've got the monetary inflation first, then you've got the asset inflation, which we're obviously seeing now, and then finally the velocity of money picks up substantially, and then you've got the price inflation that kicks in. So this is something that we've been discussing quite a bit in some of our other calls and interviews and discussions, and the amount of sort of water that's built up behind the dam that's available to create price inflation once velocity kicks in is really quite amazing. And I don't know that there's ever been an example throughout all of history that is anything like it. So it should be interesting for gold and for other types of things like that will either retain or grow in value in this kind of an inflation. Do you have any other thoughts or anything else that you want to talk about in regards to inflation that you think is important?
Well, yeah, inflation is always a long process, and I think central banks, I mean, they're very open about it. They always said that they want to create inflation. They said that inflation numbers are way too low, and now they say, temporarily we can accept some sort of overshooting of inflation. So we will perhaps we will accept 3 or 4% inflation rates, and then everything is gonna be fine. It's just this hubris that you cannot control inflation like a thermostat. It just doesn't work like that. It's a very complex project, and the thing. I think that the zeitgeist at the moment is that when you read all those very influential papers and like the Geneva Report, for example, where really the most influential people come together and discuss markets, it's pretty obvious that their conviction is that central bankers basically did their job, and now it's time for the politician. Now it's time for fiscal stimulus. And we did some studies on that, and it clearly shows that fiscal stimulus it leads much more directly into the economy, which causes inflation to pick up much faster than when it comes to monetary inflation, or let's say like central bank governed inflation, because this usually goes to the asset inflation first, and then only spills over into the rest of the market. So I think with Trump coming up, but also in the European Union, they're discussing big infrastructure projects. I think that inflation will come back big time. In fact, this is a call that we made a couple of years ago, and people were laughing at us. We said that stagflation, like in the 70s, low growth but high inflation, this will become a major concern. And if you have a look at the 70s, the nominal performance of stocks was okay, but the real performance, so the inflation adjusted performance, was a disaster. Bonds were doing not really well in the 70s. So what performed pretty well? It was gold, mining stocks, and commodities in general. And I'm seeing that the stock market is priced very, very, I would say, ambitious. Bond market is in a 35-year bull market at the very end, and very, very expensive. So what's really cheap? I would say commodities and gold. And I think that we're really at the beginning of the so-called public participation phase when it comes to gold. Last year we have seen the lows. We have seen this accumulation phase when really smart contrarian macro investors started piling into gold and mining stocks, and now we are at the beginning of this public participation phase, and this party is going to be much fun.
Yes, I agree. In fact, that's something that I've been, amongst my colleagues, we've talked about this for a long time, in that even up through 2011, the majority of investors, even in the high, we were talking a little while ago about it was fun times and it was exciting, the gold price was high. But even at that high, the number of people overall, in terms of the size of the market or the number of investors that there are, most people were not invested in gold. Some very small percentage was invested. And I think you're right. I think the next time that people become substantially invested in gold, and I'm talking, when your average person's buying gold, this is going to be a very interesting and different kind of change. I think of the markets where you listen to some financial professionals and they say that there's no reason gold should have risen to the levels that they did, that it was overpriced and that it was just ridiculous. But the truth is that a very small portion of capital compared to global capital was invested in gold and is invested in gold today. So if you look at global markets, you look at all of the bonds, you look at all of the various different markets available, you're talking some 500 trillion roughly in size, where gold is only 7 trillion of that. It's a very tiny sliver. So I agree with you. I think that
it is.
I think that when we see the average person investing in gold, this is going to be a very interesting time.
We made a in our last gold report, because we're meeting, we're speaking at so many conferences, we're meeting hundreds of professional market participants, asset managers, fund managers, private bankers. We talk to, cab drivers or nowadays you should say Uber drivers, probably.
Exactly, Uber drivers.
and we said there's basically three different kind of people when it comes to gold and the economy in general. There's the believers in the system. They think that everything is okay. They think that politicians and central bankers did a great job, and for them everything is gonna be fine. For them, their gold allocation is basically it's zero. They don't care about gold. Right. For them it's a pet rock. Right. They don't need it because everything is gonna be fine. Right. Then there's the skeptics. This is the second camp. Yeah. Those are people who harbor doubts about the sustainability of the extreme economic policy measures that have been taken. They're not sure, and for them, I think they're more of the momentum players. I think those are, for example, in financial markets, the people buying gold ETFs. It's very, very much pro-cyclical. So every time prices fall, they sell their ETFs, and when prices have risen, they buy their ETFs. And I think they are kind of questioning the whole sustainability of the current economic policy measures. And I think this camp is really, really big. they will become really, really interesting, because those are the marginal buyers, and they really could make a change. And then the third camp, of course, those are the critics, and I think both of us, we are in this camp, because we know that our whole monetary architecture is systemically flawed. We all know that a problem or a crisis that was caused by cheap money and too much debt, trying to solve that with more of more cheap money and more debt, that's not going to work. And the interesting aspect of that is it's a one-way street. I think we, the critics, will never go back and say, Alex, what Mrs. Yellen is doing, I think it makes sense. That's great what she's doing. Kuroda is doing a great job now. The 13th round of quantitative easing, that will change everything. It's a one-way street. We won't go back, and we will always say gold is money, and it's the best money that mankind ever had. So our camp will naturally become bigger and bigger.
Okay, so let's talk about the bond markets for just a moment. We have some 5,000 years of data confirming that interest rates have never been as low as they have been in recent times. So we have close to $10 trillion of government bonds with negative yields to maturity. What are your thoughts on this? And if this is a bubble, what happens when it bursts?
Well, we have seen in November when we have seen pretty aggressive moves in the bond markets, and there was I think 1.3 trillion of course of paper money wiped out. And that's a huge number, and this is of course it's deflationary. But if you're having a longer term chart, nothing really happened, and I cannot rule out that it will that we have already seen the lows in yields. For example, in the US, I think that if you compare it to yields in the Eurozone, I think it's pretty attractive actually in the US on a relative basis. But we all know that, of course, financial repression is a main cause for this final rush into bonds. We know that, talking to institutional players, they have to buy bonds, because exactly. They are riskless, as we all know, and for them it's not easy or sometimes even impossible or forbidden to buy physical gold. It's a legal thing, and it's a legal framework, and this is one very important aspect of financial repression.
Yes, totally agree. Moving on to a different topic now. One of the hot concepts right now is this idea of anti-fragility. So what are your views on this, and how do you see gold fitting into this framework?
Yeah, we wrote I think a really interesting chapter about that in our last gold report. Nassim Taleb, who I admire quite a lot, he wrote this brilliant book, Anti-Fragile: Things That Gain from Disorder. And he says basically some things benefit from shocks. They thrive and grow when exposed to volatility, randomness, disorder, and stresses, and love, adventure, risk, and uncertainty. Let us call it anti-fragile. And he thinks that stress actually is something really positive. He says that we're learning quite a lot, and we're profiting from times of stress. For example, in sports, if you always just run like 3 miles in the same pace, you probably won't get much better. So you really need this high intensity that makes you stronger. And he develops this picture of anti-fragility, and it's really not easy to explain that, as it's such a brilliant book. But what we tried to explain is if in a portfolio context, gold makes your portfolio anti-fragile. And we came up with some very interesting thoughts. And first of all, we said that if you're having a look at gold in a portfolio context, actually the years when the S&P 500 was losing most were years when gold did tremendously well. So there's a high negative correlation between gold and stocks, especially when stocks crash. Then we're talking of course about the natural let's say entropy of gold. Gold is intrinsically stable and durable because of its physical durability. It's got a very stable total stock. This is something that most people forget, the so-called stock to flow ratio. The amount of gold, so the natural inflation, let's put it that way, of gold is 1.5%. This is how the roughly 180,000 tons of gold, how this amount of gold grows every year, 1.5%. So this is roughly population growth at the moment, which is pretty interesting, I think. So that's much lower, this 1.5%, and much more stable compared to monetary inflation, which is running at on average 7% every year. So there's 7% more money in the economy. That's what I would call a loss of purchasing power.
No doubt
then,
about
of course, gold is extremely liquid, even in stress situations, especially in stress situations. So it's one of the most liquid investment assets, one of the most liquid currencies on Earth, and that makes gold very, very robust. It also has some sort of a reciprocal relationship with the monetary system. So basically gold, as you know, it doesn't have any counterparty risk. It's pure possession, and this also means that that it's a natural hedge against financial crises. And of course, there's quite a lot of other aspects. So we came up with the conclusion that gold makes your portfolio more anti-fragile. And there are several ways how you can play it. We always say you have to differentiate between performance gold and safety or insurance gold. If you really want to speculate on rising gold prices, that's fair enough. You can buy ETFs, you can buy futures, options, you can buy mining stocks. But if you want to really buy insurance against hyperinflation, against monetary reforms, wars, whatever, then you should buy any ETFs or certificates. But then you really should care about counterparty risk, and then you should own physical gold. You should store it in a very, very safe jurisdiction. You should store it outside of the banking system and so on. So this is really important to differentiate. What's the purpose why you're buying gold?
Yes, absolutely agree. Okay, so wrapping things up, do you want to talk about any scenarios that you see moving forward? Are there any sort of likely scenarios you see playing out, and on the flip side of that, other scenarios that maybe are less likely, and how do you see these things happening over, let's say, the next 2, 3, 4, 5 years?
Well, I should be cautious because I said before that the Austrian school doesn't make any forecasts, or is very let's say strict when it comes to making big calls. But of course, as an analyst and as a fund manager, I have to do, but I also have to prepare for different scenarios, and that's basically what we're doing. I think that our main case is basically from reflation to stagflation. We really studied the stagflation of the 1970s quite a lot, and we came up with quite a number of similarities. So stagflation is really something that we believe that is quite possibly gonna happen. Then of course there's the Goldilocks scenario where everything is gonna be fine. I think we should not be too pessimistic. There's a beautiful book by Julian Simon. It's called The Ultimate Resource, and the ultimate resource is basically in between our two ears. It's our brain, and we should not forget that human beings are extremely innovative, and there's quite a lot of positive things going on in technology and so on. Also in the blockchain developments, bitcoins, cryptocurrencies, and so on. There's very interesting stuff going on. I think that, of course, the election of Donald Trump might be some sort of a real game changer in politics. I often say that I'm not sure he's probably going to be the worst or the best president for decades. Yeah, you just don't
it's
know.
Yet to be known, right? It could go either way.
But I think if in the first couple of days, I think he also did really some good things, and he actually delivered the things that he promised in the campaign, which is not so common with politicians. So I think that in the gold scene, people are often too negative and try to they should avoid the confirmation bias, only seeing negative things.
Yep, I agree.
But still, there's basic math, and we just have this huge pile of debt, and it has to be liquidated sooner or later. It can be liquidated by inflation, which is what politicians and central bankers prefer. It can happen through a debt restructuring. It can happen to defaults due to deflation. There's only a few ways out, but it will happen sooner or later. But either if we make the stagflation call, or the inflation call, or also the deflation call, or the Goldilocks scenario, I think that gold just has to be part of your portfolio. As I've said before, I really mostly read about history, about monetary history, about politics. I don't care about daily noise that is happening every day. I try to understand the big picture. And I think at the moment, when we're in big currency wars, because Donald Trump basically said, and this is something that U.S. presidents for many years never did. He talked about the dollar, and he said the dollar is too strong. So this basically means, as also Jim Ricketts would probably agree, that we're in a new round of currency wars. And we know that Mr. Draghi wants a lower euro. We know that Mr. Kuroda in Japan wants a lower Japanese yen. We know that the Chinese want a weaker yuan or renminbi. So the beauty is that gold is not participating in currency wars. So that basically means that your purchasing power, I'm not sure if gold is the right thing to become rich, but it's definitely a great choice if you want to stay rich. So I think this environment, you just have to own gold.
Yep. Is there anything else that you would like to talk about that you consider important for people to know, for our listeners to know, that we haven't covered yet today?
we could talk about soccer in Austria, but I think that's probably one of the most useless pieces of information for your listeners. We talked about quite a lot of different interesting topics. We've got quite a lot of research on our webpage. We're already working. We Trust report is going to be published on 1st of June.
Okay. Look forward to that.
And yeah, there's so many interesting things. Yeah, to write and to think about and to research. I think it's going to be an interesting publication again.
Yeah, very much looking forward to it as always. Every year, it's one of the publications that I don't miss, and I think really anybody in our industry and anybody who's has any interest whatsoever, it would be greatly benefited by taking a look at it. So for those of you who are interested, we will be posting links to where you can get more information about Ronald Stoeferle and the In Gold We Trust report, and it will be located in the information section of this podcast. Ronnie, I want to thank you so much for your time today. It's been a great discussion, and really appreciate it.
Thank you very much, Alex. It's been a great pleasure, and all the best to you and your listeners. Thank you very much. Take care.
Thank you, Ronald Peter Stoeferle, for sharing your insights with us today. And thank you, Alex Stanczyk. And most of all, thank you to our listeners for joining us in this second edition of Global Perspectives. Let me encourage you to follow Alex on Twitter. His handle is @AlexStanczyk. If you've enjoyed this podcast, please recommend it to your friends. If you're watching on YouTube, please click like and subscribe. And if you're listening on iTunes, please give us a rating and a review. So goodbye for now, and we look forward to joining you again soon. You have been listening to Global Perspectives with Alex Stanczyk, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Alex Stanczyk and other thought leaders in the fields of geopolitics, economics, and the global monetary system. Physical Gold Fund presents Global Perspectives with Alex Stanczyk and invited guests. We'll be exploring international markets and the complex forces that drive them, including geopolitics, economics, and the global monetary system. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to the latest podcast with Alex Stanczyk in the series we're calling Global Perspectives. Alex Stanczyk is the Managing Director of Physical Gold Fund. Alex is an expert in the physical gold industry, dealing with the logistics chain from refinery to secure transport and vaulting, and he's lectured globally to investor, institutional and government audiences on the role of gold both in the international monetary system and in investment portfolios. Our guest today is Ronald Peter Stoeferle. Ronald is managing partner and fund manager at Incrementum AG. His company focuses on asset management and wealth management and is based in the Principality of Liechtenstein. Before becoming a partner at Incrementum, Ronald Peter Stoeferle worked in the
years ago at a gold conference in London. Since then, your report, the In Gold We Trust report, has become commonly known as perhaps the most closely read annual report in our entire industry. So congratulations on that great success, Ronnie. I'm a big fan.
Thank you very much, Alex. Thanks for having me. It's true, we know each other for ages, it seems, but I think we met the first time personally at the conference in London when gold was really close to its all-time high at 1900. It was back in the good old days.
The good old days, yep.
We'll get back to that.
I'm sure we will. It's interesting. At the top, everybody's always quite happy, right? And that should have been a good indication. But who knew?
Yeah.
Who knew? Okay, so I'd like to start out with a quote. And this quote comes from your In Gold We Trust report. and it's from Russell Napier. And the quote is, "The time is coming when global financial markets stop focusing on how much more medicine they will get and instead start focusing on the fact that it doesn't work." So, generating growth.
Research department of Vienna-based Erste Group, where he started writing about gold in 2006. In 2015, he published his first book, Austrian School for Investors, Investing Between Inflation and Deflation. Ronald is the author of the annual report, In Gold We Trust, which was named as the gold standard of gold research by the Wall Street Journal. The 10th edition of In Gold We Trust was released in 2016 and gained immediate worldwide recognition, with newspaper coverage in more than 60 countries. Jim Rickards has described In Gold We Trust as the most eagerly awaited and closely read report in the gold community. So, of course, we're especially excited to be talking with Ronald Peter Stoeferle today. Now, Alex, over to you.
Ronnie Stoeferle, welcome to the call. I'm very excited to have you on. I really appreciate you coming on and spending some time with us. I've been looking forward to having you in a conversation like this for some time now. We first met about 6 years. Inflation has sort of been the central banker's goal worldwide for some time now. And, in light of the observation that this does not seem to be working too well, talk to me about your thoughts on this.
Well, in Japan, we're already having the 12th round of quantitative easing. They call it QQE, so quantitative and qualitative easing. So they're also buying stocks, ETFs, and REITs now. But for some reason, people are not really questioning if it actually makes sense, because if it would work, then why do you need 12 rounds of it? So I think we're in some sort of an end game where the central bankers are basically the only ones who try to hold everything together, but we all know that at the end they're gonna make it worse, because I think you're also a keen reader of history, of monetary history, Austrian School of Economics, and we all know that we're in a big spiral of interventionism. And just the fact that the markets these days are only discussing what will Janet Yellen say next, what will this regional Fed director say next, how do we value this piece of information. It's crazy. The market only cares about central banks anymore, and this clearly shows you that this is not a healthy market anymore.
Sure, that makes a great deal of sense. What it reminds me of is the South Seas bubble. I know you read history, as you know I do, and if you read sort of the commentary and the thoughts and the processes of what was going on at the time, it's so similar to these types of really kind of crazy bubbles that we've seen in history, like the tulip madness bubble and the South Seas, etc. It's almost like people have become, completely disconnected from reality and so engaged in this process.